Markets kind of chill at the start, 30 minutes until the opening bell. I'm Matt Miller. Dani Berger is on assignment. Open Interest starts right now. Coming up, time is ticking away. The U.S. heads toward a government shutdown as the BLS confirms this week's jobs report may be delayed. CoreWeave inks a deal with Meta that underscores the massive costs of developing and running advanced AI models. And speaking of deals, deal making is back on Wall Street. Jefferies records record revenue for the third quarter and signals a positive outlook for bank earnings season as it kicks off those numbers. In terms of the stocks to watch, CoreWeave is up another 10% after a more than $14 billion deal with Meta. Remember, CoreWeave doesn't make the chips, doesn't make the servers, it just sets everything up, and then Meta comes in and uses CoreWeave essentially as a middleman. In terms of banking and the outlook, it is positive. Jefferies is the first one to kick it off, and we still have really a couple weeks to go until the other banks come out. But Jefferies right now up almost 1% as it says deal making is back, and volatility really helped it in the last quarter in terms of trading. Finally, Exxon Mobil down a little bit, even though Exxon is cutting 2,000 jobs, continues to take out costs. They've taken out more than $13 billion since 2019 and are far outperforming all of the other major oil producers, even as the price starts to fall. Vice President J.D. Vance believes the U.S. government is on track to shut down. He spoke yesterday at the White House, pointing the finger at the Democratic Party.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
The Bureau of Labor and Statistics says they are not planning to release data during the shutdown. If we do have a shutdown, they'll only have one employee left. It could lead to jobless claims, non-farm payrolls, CPI, retail sales, PPI data all being delayed. And that may have an effect on the market. Joining us now to talk about whether or not this is going to happen, Anne-Marie Horder, Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance. And it does look like, at least for a bit, we'll get a shutdown because they only have, 15 hours left.
Well, also the House is not even in session, so there will be a government shutdown. It's not really a matter of if anymore. It's going to be a question of how long we were going to have this government shutdown. Potentially, of course, that is going to affect, as you mentioned, the jobs report on Friday. BLS already coming out saying that we're going to basically cease when it comes to these economic reports. We saw this in the past with some government shutdowns. I guess there is a way we could see the jobs report if the president deemed it so essential and kept a few members of the BLS on board to make sure that the job report gets sent out, because all the collection would have been done. But then we also have CPI on October 15th, and then, of course, the Fed meets at the end of the month. So this is going to be very challenging for the Fed if it is a prolonged shutdown and they don't have the most up-to-date data in terms of how they view the economy and whether or not they're going to cut interest rates again.
Well, even if it's not prolonged, it's interesting to me because that the Democrats would let this happen, because the Democrats typically are against shutdowns. They're for federal workers, and the president has threatened to use this. You know, typically federal workers are furloughed and then given back pay when they come back, but he's said he's going to fire them all.
Well, there was this memo and talk of that. I think right now that still remains a threat that the Republicans, the White House, is using to try to get Democrats on board to sign up for this continuing resolution and keep the government open. Politically, for the Democrats, you know, they're taking a lot of heat. Leaders like Senate Minority Leader Chuck Schumer and Leader Hakeem Jeffries, because their party feels like they're not doing enough to stand up to this White House. What you have right now is Republicans controlling the House, the Senate, and the executive branch. This is just one way that Democrats are trying to use the shutdown as leverage to get some extractions.
As leverage. So they essentially are okay with holding the federal budget hostage to get what they want.
They want something. They want concessions from this White House, especially when it comes to the health care world and when it comes to the Affordable Care Act and some of these subsidies. They want to have a conversation on this. What was interesting yesterday, and I was at the White House, so I heard from J.D. Vance, the vice president, Speaker Johnson, Senate Minority Leader Schumer, Hakeem Jefferies talking about this. There was one area where J.D. Vance, it was interesting. He said, I think we're headed towards a shutdown. But he did talk about the fact that maybe when it comes to rural hospitals, this can be a place where they can have a conversation. So potentially there is a deal that gets done behind the scenes that Democrats sign up for a continuing resolution, keep the government open. Not today. I mean, this is going to be a story for this week or next week. But then there is some sort of agreement when it comes to things they need to work out, maybe when it comes to rural hospitals, a place where they can find some sort of consensus.
All right. So fascinating when the shoe's on the other foot. Anne-Marie Hordern, our chief...
It's politics.
Our chief political correspondent. Thank you very much for reminding me of that. CoreWeave, this is not politics, I guess, inked a deal, a $14 billion and change deal to power Meta's AI efforts, helping diversify CoreWeave's business outside of Microsoft. Let's dig into this with Bloomberg Tech co-host Caroline Hyde. And Caroline, their CoreWeave is what's known as a neo-cloud business, right? So they don't make the chips, they don't make the servers, they don't build these data centers, but they, I guess, rent their cloud space out to a hyperscaler like Meta.
And they are buying the GPUs, they are furnishing the data centers, and they're therefore renting compute at the moment to the hyperscalers. And they had about 70% of their revenue coming from one key player, Microsoft, as of the end of June. Now they're really showing this diversification. They just inked a deal with OpenAI, bringing more than $6 billion to enlarge their overall focused at $22 billion contract with OpenAI, and now they've inked another $14 billion with Meta. It's interesting, before this news came out, Evercore ISI had just raised their overall view on CoreWeave, saying this really has a singular advantage for the company, because not only are they going to be focusing on access to compute for the hyperscalers, but they're also going to be winning over enterprise as well. Companies are going to need this sort of compute to run their AI applications more broadly. They think that they could be having a winning formula here at the moment. So you've got CoreWeave, you've also got others like Nebius is one that's here in the United States, traded on the NASDAQ. They've also been doing deals recently. You've got Nscale over in Europe. A lot of these companies are financed on a lot of debt. They've got a lot of very creative financing, perhaps financing on the actual GPUs coming from NVIDIA. And it is indeed NVIDIA that's going to be underlying this compute that's going to Meta.
What I don't get is why Meta, which is, almost a $2 trillion business and knows it's going to need compute for the future, why don't they just do this themselves? What do they get from CoreWeave that they can't replicate?
Access now. I mean, CoreWeave's already been building out its infrastructure, and at the moment you then have a diversification. Yes, they want to build their own data centers. And remember, Meta just did a $29 billion creative financing of its own, a private credit deal, where it's got money to go into that enormous AI data center that they're building in Louisiana. That's basically the same size as Manhattan. Exactly. And I think at the moment, Meta just itself can't build it fast enough, can't get creative fast enough, and needs to spread its own over diversification. You're seeing that's why Microsoft does rely on CoreWeave. That's why you've got Oracle can't build it quickly enough. They're having to finance at the moment and build out, and they've got a big contract, $300 billion with OpenAI. Just the sheer scale is gargantuan. But that is why you're starting to have Moody's and other rating agencies say there are risks built into this system. And more broadly, I think it was Gil Luria who's been writing about the fact that OpenAI itself needs to have revenues of about $300 billion by 2030 to really vindicate and offset some of the overall financing they're having to take on to scale to this level of compute. The infrastructure is just extraordinary, but that's what CoreWeave is as kind of infrastructure as a service.
All right, very cool story, Caroline. Look forward to your coverage of this with Ed Ludlow. Caroline co-anchors the Bloomberg Tech Show with Ed. Later today, actually, Ed is going to discuss AI in home products like Alexa with Amazon's Senior Vice President of Products and Services. I should say Caroline and Ed will talk about that with Panos Panay, so definitely don't miss that interview this afternoon. Tuning to Wall Street, Jefferies reporting record quarterly revenue, or at least for the third quarter, as deal activity picked up worldwide. Bloomberg's Catherine Doherty covers the banking sector for us, and so correct me if I'm wrong. This is the most money they've ever made in the third quarter and the most money they've ever made from advisory.
This is the best quarter for advisory ever on record. And overall revenue is still the best since the first quarter of 2021, when we were seeing deal making really surge in a way coming out of the pandemic. So it's huge sign for the big banks that are going to report in October. We're going to wait for them to put out their results, but all signs are pointing to a resurgence of deal making and trading. The narrative has been for really the first half of the year. Volatility has been up. That's been good for trading desks. It's bled into a lot of their revenue that we expect to continue for the rest of the year. But it's deals that started out in a tepid moment in 2025. We had a lot of companies that were holding back from M&A, holding back from issuance, and now we're seeing the floodgates open. And what Jefferies is pointing to is not just the activity that they recorded in the third quarter, but for the remainder of the year and into 2026, they're saying all bets are off. This is really go time for us, and our dialogue with companies that are looking for future M&A opportunities is continuing. This is not just a one-off trend.
So the big bank earnings, the other ones, don't come out until October 14th, October 15th. But this is a sign that we're going to get positive M&A advisory from those other big banks, right? And I guess trading too, because that volatility that they say drove revenue all came in April.
That's right. It all came in April, but this quarter was really going through the summertime. And what's interesting is Jefferies' results that we're seeing today, they ended at the end of August. So normally the summertime can be a pullback in activity.
Yeah.
We didn't see that. So now there's this positive momentum that there's no reason that we won't see that. Even let's look beyond the third quarter into the remaining 3 months of 2025. It looks like it's going to be a record year for the banks. The whole sector has seen a surgence in trading, as you mentioned, but it was deal making that the executives at the beginning of the year came into the 2025 saying, this is our year. We're going into a different environment in terms of regulation that we have been constrained by and that the companies that we bank with have been constrained by. And the expectation was that that was going to come through in their revenue for advisory. We didn't see that at the beginning of the year just because of all the questions that remained around tariff negotiations and geopolitical concerns. So now what we are expected to see to end the year is the positive momentum that the CEOs were talking about to begin. They were saying, this is going to come, this is going to come. Now with Jefferies' results, we're seeing it actually come through.
All right, very cool. So they're basically a month ahead of the other banks. Jefferies' fiscal year ends in November. Catherine Doherty covering all the banks for us here at Bloomberg. Coming up, Exxon cutting jobs as part of a longer-term restructuring plan, but it adds to a number of job cuts we've seen at the other oil majors, and it comes on a day when we hear reports that OPEC could increase production, which pulls down the price of the underlying commodity. This is Bloomberg. Exxon will lay off about 2,000 employees globally as part of its long-term restructuring plan. Let's discuss with Bloomberg's managing editor for commodities, Simon Casey. He joins me here on the desk. And this is really an amazing ongoing story of taking out costs. Yeah. The new CEO, or the most recent CEO, has taken out $13.5 billion of costs since 2019.
Yeah, that's a lot of cost. But the news this morning is just the latest in a series of restructurings, cost reductions. And the background against this is happening against is oil prices that are not catastrophically low. They're not great. They're kind of like a little bit almost like a Goldilocks level. Exxon can operate just fine, but it's insulating itself from a potential downturn. Next year, we're seeing forecasts of quite a big surplus, maybe. Demand could slow a bit more in China. You've had growing production up to this point in the United States. We've got more production coming online, of course, from OPEC. So prices are under pressure, and oil majors, and Exxon included, have to protect themselves from this pressure on their margins.
You mentioned OPEC. We saw a headline. I think the delegate today reported that they're going to take or increase production over 3 months by 500,000 barrels, even though the prices are already low, right? 62, 67, depending which contracts you look at. Why is OPEC Plus going to continue to boost production?
Saudis want to regain market share. I mean, they've lost quite considerable market share over the last several years. The United States is the largest oil producer by quite some margin now, and that's a reversal from just a few years back. They want to regain that leadership. They see an opportunity here. US production has been growing. It's beginning to plateau out. The shale production that we've seen in the post-pandemic years, it's topping out now. The US companies are focusing primarily on their cash flow. They're not prioritizing production growth just for the sake of it. The Saudis see an opportunity there. If US production goes into a slow, gradual decline, they may bring back even more.
I was shocked the other day when I pulled up to a gas station in Bedford, New York, and saw $7 oil. That's an incredible outlier for New York. But in California, that would not be as shocking. And we had a great story on the Bloomberg terminal yesterday about Gavin Newsom having to pivot away from his attacks on fossil fuel producers because California faces potentially $8 a gallon for gasoline.
Yeah, it's suddenly got very real for Gavin Newsom. $7 would be a pretty good deal, I think, in California right now, in some parts of California. He's spent years really sort of leading a campaign against the oil companies, burnishing his environmental credentials. The oil companies have just been voting with their feet. I mean, we saw Chevron not so long ago re-domicile. It's moved its headquarters out of the Bay Area to Texas. But on a more sort of fundamental level, we've seen refinery shutdowns when it's very expensive to operate refineries in California. And then there was a proposal pushed by Newsom to cap the profitability of refining oil in the state. Refineries are getting shut down. It's got to the point now where there's a limited supply. It's quite precarious. And when you have refineries fall over, they go on maintenance, they have issues, they go offline. You've got the possibility of real gas shortages, gasoline shortages there, and it's very difficult to sort of import it from another part of the world because they have a specific blend in that state as well. It's a real problem for him. So he is pivoting. He's suddenly being very supportive, and it's quite a contrast to where he was just a few months ago.
I mean, it's all the problem is all the bigger when you consider the fact that they occasionally have to tell people not to charge their cars because the grid can't take it.
Exactly.
So no electricity, no gas. It's
gas,
a tough situation. Simon, great coverage. Your team has done an incredible job. Simon Casey there runs commodities for us here at Bloomberg. Let's get to high interest right now. Look at what else is making headlines around the world. Global FX trading hit a record $9.6 trillion a day, according to the Bank for International Settlements. That's up 28% from 2022. President Trump's tariffs sparked April's wild swing, sending the dollar down and volatility to two-year highs. The greenback still dominated nearly 90% of trades, but sterling slid while China's yuan gained some ground. London has fallen out of the world's top 20 IPO markets, slipping to 23rd place behind Mexico, Singapore, and even Oman. New listings in the UK are down nearly 70% this year to just $248 million. It's the weakest in over 30 years. By contrast, Singapore and Mexico have surged into the global top ranks, while big names like Unilever have chosen rival European hubs for their IPOs. And Josh Pack, the co-CEO of Fortress Investment Group, has died at just 51 years old. No cause of death has been given. Pack joined Fortress 23 years ago from Wells Fargo and was planning a move to London to drive European growth for the firm. Drew McKnight will continue leading the company alongside new co-CEO Jack Newmark. Pack is remembered as a devoted husband and father. It is the final trading day of the month, and the S&P 500 is on track for its best September since 2010. Equity positioning doesn't appear stretched, keeping many in the market positive for the fourth quarter. But government shutdown, the potential of that this week could leave many traders in the dark with economic data like the jobs report, like CPI, PPI, retail sales, all of them at risk of delay. Joining me now is Truist's Chief Investment Officer and Chief Market Strategist, Keith Lerner. Keith, let's talk first about, a statement that I made that I'm not sure if it's true. Equity positioning doesn't seem stretched. Is that true? Because PEs are relatively high, and U.S. households are more allocated to equities than ever before, as are foreign investors.
Yeah, well, first, great to be with you. And when I look at the overall mix of sentiment data and position, I would say it's somewhat high, but it's not excessive. And at this point, it's not enough in our work to make a major call. Typically, sentiment and position data really matters at the extremes. And to your point, you could say expectations for this market are somewhat high as you're trading at, the high multiple of this cycle. But overall, I mean, there's also some trepidation as you think about what's the discussion the last couple of weeks, government shutdowns. There's a lot of calls I'm getting about, hey, valuations, are we in a bubble? So again, expectations are high, but I don't think we're in extremes as far as sentiment as of now.
When we look for further price appreciation, do we expect institutions to be doing more buying? Do you think households, retail traders are going to be doing more buying? Do foreign investors do more buying? I mean, where does that marginal dollar come from?
Yeah, I think it's somewhat of all of the above. I think there's a steady flow of each, and as the economy continues to chug along, and as you have automatic investing and monthly investing, and a lot of, if you look overall at allocations from the sell side, it's somewhat more neutral. So I think there's still some room to move up. Is that the key driver? Maybe not. I think earnings are going to be the key driver for this market to continue to get some gains. And maybe Matt, I'll throw one stat at you. We bucked the historical weakness of September. When we head into the fourth quarter, one question I'm getting is when we have this big third quarter, do we tend to see gains? And historically we have. I mean, the fourth quarter, as most of us know, tends to be a seasonally strong period. When you go into that quarter, when you have 25 new highs or record highs for the year, you actually improve in that. You're up about 89% of the time. The average return is 5%. Doesn't mean we're not going to see some hiccups along the way, but momentum tends to feed on itself.
All right, Keith, we're going to continue talking about this, and I'm going to find out what you think of a possible government shutdown. Keith Lerner stays with us. Quick check on futures as we head to the opening bell. We're looking at the S&P futures down, but only by 0.1%. This is Bloomberg. Moments away from the start of trading on this Tuesday. Dani Berger is unfortunately on assignment. But I'm here, Matt Miller. This is Bloomberg Open Interest. We're looking at a drop on futures, just 0.1% on S&P futures, even less than that on the NASDAQ. Down the New York Stock Exchange, you've got Blue Owl Technology Finance ringing the bell. Craig Packer there, the president. They have just started trading over the summer, lost about 15% of their value since then, but it's a very popular space. We're looking at Crinetics Pharmaceuticals down at the NASDAQ market site. Now, they had more than doubled over the past 5 years, but recent gains have pushed them up almost to triple territory. Gains of 177% over the past 5 years for Crinetics. In terms of your stocks to watch today, CoreWeave has to be the big winner here, up more than 10% after Meta, Facebook, said it's going to buy more than $14 billion worth of compute, or rent it, I guess, as it were, from CoreWeave. That helps the stock rise to almost $135 a share. Jefferies comes out a little bit ahead of the other big investment banks because its fiscal year ends in November, and had great news on deals. They say M&A is back. Trading really picked up in the quarter because of the volatility that you saw there. And then Exxon Mobil actually down by about 1% right now to $113.20 a share. They're firing another 2,000 employees in a restructuring that's been going on since Darren Woods came on as CEO. He's taken out $13.5 billion in costs since 2019. That's more than cost cutting at all of the other majors combined, which really makes you wonder about how much money his predecessor was spending. But let's get back to the broader market. We're back with Truist Chief Investment Officer and Chief Market Strategist Keith Lerner. Keith, we're looking at the potential of a government shutdown less than 15 hours from now. Most people think it's going to happen. How much does this matter for stocks?
By itself, historically, not a lot. Doesn't mean it does add one more bit of, confusion or complexity to the market. But we've looked at the last 20 shutdowns going back to the 70s. And what's notable is stocks during the shutdown period have been up 50% of the time, and the average return is about half. Now, there's certainly some variation between that, but eventually, what happens is we move past these shutdowns. The longest one was the last one in 2018, which was about 35 days. There is a wrinkle with what happens on the employment side and not having data as an example. But beyond the short term, this is not something that we would change our investment focus based on just some of this near-term uncertainty.
And you argue that, the bull market is the effect of these double-digit gains that we've seen in earnings for quarters. I wonder what would make you defensive? What would change the way you're positioning? If not a government shutdown, and we're still expecting earnings to be strong in the third quarter, what would change your mind?
Yeah, it's a good question. It's a fair question, especially as we have valuations of which are somewhat rich. But the North Star of this bull market has been earnings. So it would be earnings. And, even if we don't get some government data releases in 2 weeks, we'll start to get the start of the next earnings season, which will be really important. But, as stocks have made all-time highs here, what we're seeing is that the S&P forward earning estimates are also at an all-time high. We're also seeing that earnings broaden out to the equal weight index. We're seeing small cap earnings move up as well. So what would get us more negative would be that we start to see a moderation in earnings, especially as we're at a higher level, or some really extreme in move in the overall market where we just think that all the good news is baked in. And just as an example, a lot of discussion about are we in a bubble. The technology sector over the last year is up about 27%. What we've seen on a year-over-year basis where that's been problematic has been when you move, up 75%, up 100%. So we're just not there, and it's all about earnings in our view.
You've upgraded small caps, which is brave considering the history of people who stick their head out for these stocks. What are the catalysts here, you think, for small caps? Is this about Fed rate cuts?
Yeah, and I don't know how brave we are because we upgrade them from less attractive to neutral. And we're thinking about it. We still think, the dominant story for this market is tech and AI. That's where the strongest earnings growth continues to be. But on the margin, things have improved. One, we already know they've underperformed by a lot. So that's just a condition, not a catalyst. But what's changed over recent months is we're starting to see those earnings move higher. In this one big, beautiful bill, there was a lot of incentives for more leveraged companies, which small caps are. You're also now seeing, at least one more rate cut and more next year. And also positioning you talked about positioning for the overall market. Well, positioning for small caps has been very light. Earlier this year, we saw the most extreme outflows that we've seen in several years. So again, extreme condition, underperformance, better earnings, and the sentiment backdrop is somewhat constructive.
I wonder where the second derivative opportunities are. We've been talking about CoreWeave this morning, and I don't know if that counts as first or second, but we're going to talk to Oklo, for example. Obviously, power has been a huge story. What do you see as, maybe the uncovered investment opportunities in AI?
Yeah, I don't know that it's uncovered yet. I think at some point, and we're not there yet, that you'll start to see the AI transformation really moved down to the 493, the other stocks in the market. But at this point, the equal weight index relative to large caps or the S&P, the market cap index, just made like a 20-year low. So I think that's eventually to happen, Matt. Our strategy is wait for a little bit of confirmation, not try to pick the bottom. But I think that is maybe as we think about next 3 to 5 years, it's not just about these hyperscalers. It's about how everyday companies use this technology to become more efficient, maybe boost profit margins, but we're just not there yet. So in the interim, we're still sticking with, the big boys. We're sticking with tech, which we've been overweight, and communication services, which we've been overweight all year long. I think there are some opportunities still in the power side with utilities. We're more neutral there, but certainly some opportunities acting somewhat better, as well.
All right, Keith, great having you on the program. Thanks for joining us. Truist Chief Investment Officer and Chief Market Strategist, Keith Lerner. Hope to get you back in the office soon. I hear we're going to play pickleball when you and Dani are back here. Let's get a check on the stock market right now. We're looking at losses on the overall index, and you can see we've come down a bit from the top of the middle, I should say, of the hour right now. We have 221 gainers, 277 losers. In terms of the gaining side of the ledger, Nvidia obviously right up there on top. It's always going to be on one side or the other just because of its size. But you start to see the others. Broadcom, instead of a Mag 7, maybe a Great 8 creeping higher. And then you see some of the banks, JP Morgan, moving up here as well after those Jefferies results. On the downside, you see Microsoft right now down only about 0.7%, but again, $4 trillion stocks tend to be on the high end of these boards because we have them set up by points rather than percentage change. Meta also down 1 2/3% after we heard it's going to pay more than $14 billion to rent compute from CoreWeave, and then you have the other hyperscalers on the way down. So Alphabet, Amazon are down, as well as some of the other big tech stocks like Tesla and Netflix. We talked about Exxon. Coming up, U.S. nuclear power startup Oklo makes a $5 million bet on a Swedish peer. We'll speak to Jake DeWitte of Oklo and Jacob Stedman from Blykalla next. This is Bloomberg Open Interest. Time now for our top calls, some of the analyst action and focus this morning. First up, Celsius Holdings is getting upgraded to a buy at Morgan Stanley. The analyst citing top-line growth ahead for the energy drink maker. The stock has more than doubled so far this year, and, well, it looks like they think it can go even higher. Next up, Mitsuho has initiated coverage of U.S. internet stocks, naming Meta as a top pick. The analyst says Meta is best positioned for AI. The firm is also initiating buy ratings on Alphabet, Amazon, and Airbnb. And finally, Bank of America is downgrading nuclear companies like NuScale Power and Oklo because of what it sees as unrealistic valuations and a negative risk reward. The analyst says Oklo faces a fuel scarcity, and we're going to talk to the company's CEO about that right now. Oklo announced also a $5 million investment in Swedish peer Blykalla. The deal is part of a collaboration between the two companies on technology, supply chains, and regulation. We spoke with Ken West yesterday of Honeywell on the growing demand around the world for power.
The world will need more power tomorrow than it needs today. In fact, many of the forecasts say that we will need more than 30% more energy by 2050 than we have just today.
Joining me now at the desk, Jake DeWitte, Oklo CEO, and Jacob Stedman, Blykalla CEO. Gentlemen, welcome to the program. Thanks so much for joining us. Jake, let me start with you just to get a response to the overvaluation allegations. I mean, there's so many things you can control at your business, but valuation's really not one of them. What do you think about the price Wall Street is putting on your business?
I think one of the aspects here still is this story has so many details to it that people are still unpacking. And I think there's still sort of a recognition of what's happening there. What we announced last month, I guess it was earlier this month, in terms of investing in fuel recycling, is a massive unlock, a part of the story that hasn't actually been fully appreciated about what that does, not just for solving fuel scarcity issues, but changing fuel economics in a fundamental way and opening up different revenue streams. And that's just a small example. Then what we're going to talk about here a little more today, partnering on a transatlantic basis, opens up additional partnership opportunities and opportunities for growth on a more kind of global scale. So I think there's still a lot of details of the story being, unpacked. There's obviously a lot of excitement, which is cool to see. But at the end of the day, execution proves it all out. So that's what we got to do.
Jacob Stedman, come in here and tell us about the deal that you've made, what you're going to do with the money, and how you plan to work together.
Yeah, thank you for having me here. So Oklo is investing $5 million into Blykalla, and it's also we signed a transatlantic partnership. I think it's one of the first of its kind. So we have three areas, as you said, about collaboration. So one is, for example, on fuel. Oklo is investing heavily in fuel fabrication, and that's great for us because we, as everybody else, also needs fuel. So we hope to procure that fuel in the future, the fuel made here in the United States, and hopefully also maybe co-invest together in facilities like this. So that's one area, and then also working with supplier development, for example. There are big capacity shortages, and we hope to solve them by creating aggregate demand.
Will this, Jake DeWitte, get you to, I have two Jakes here on set.
Yeah,
so, will this get you closer to commercial deployment? Because that's, for me, like one of the most exciting milestones that we are waiting to see.
This partnership alone, no. But we are taking a lot of steps. I mean, there's so much happening that's even just transpired since the executive orders. And I agree, getting that first plant built is exciting. But here's how I think about it. If we swing at one plant, you know, that's the wrong thing to do. We have to swing through and beyond, because what we're talking about an opportunity, what you mentioned in your prior segment, 30% growth, I actually think that might be soft. You look at the goals set by President Biden, President Trump, we need hundreds of gigawatts of new nuclear. So this partnership's about scaling beyond that first one, well through it and above. So it's opening up the door for significant, not just domestic expansion, because they might be investing in and buying fuel fabrication capacity from us, but also we can work with them about opening the door for more suppliers to come to the table so that we can actually build more plants both domestically and internationally. So I think it works actually pretty favorably.
You have, I think, a vertically integrated strategy, right? And how do these partnerships, how will this play into it? Will we see more like this?
It does. So we have a lot of constraints, like Jacob was saying, in the supply chain. And we can work together with suppliers to acquire more components together is a great way to sort of unlock some of that and grow that and make investments that we're going to make, that they're going to make, that we might make together in things as well, like fuel fabrication. It's not just about the fuel material, like they talk about scarcity, it's also fabricating it. So we're making investments across the whole chain, and then that will help us serve their needs as well.
Jacob, what are your needs and what are Europeans prepared to do here? I mean, Sweden, my experience is in Germany, where they have gone the other direction from nuclear, right? But the rest of Europe may see it differently.
Yes, I think Sweden is obviously a much smaller place than the United States, but the government is extremely pro-nuclear. So we are going to double the electricity generation over the next 25 years, even more in percentage than here. So doubling means building a lot of new nuclear. The government put up a roadmap saying we're going to build 10 gigawatts more of nuclear capacity, and we intend to be a big part of that solution.
And your concerns about supply chain, your concerns about fuel, are helped, I guess, by this investment.
Exactly. I mean, I think it's a win-win. It's actually a win-win-win because it's also good for the suppliers. So, you know, if we come together and create aggregate demand, it's much easier for a single supplier to say, here is a customer group that wants the same things, and then they can invest in capacity and get it built.
So when will we see these, your first plants built? Or I know you want to swing through and look at more, but when are we going to see actual deployment? Because until then, analysts are going to say these things about valuations, right? I'm not going to find really a PE or not much of one.
Yeah, well, I think these are the things that start to unpack the story in different dimensions, like we just talked about. But in terms of answering your question, one of the really exciting things that came out from President Trump's executive orders that build on stuff that passed in the Advance Act under President Biden is this acceleration on the regulatory front and opening up the apertures for different regulatory pathways, including, for example, the Department of Energy's reactor pilot program. We had not one, not two, actually 3 reactors selected into that. And that program is built to enable plants to turn on by July 4th, 2026. Now, not all plants and not all designs are going to be able to do that because of supply chain constraints, but we have like sort of the work in place to bring forward. We expect at least one of our reactors to hit that date, and then we expect follow-on plants to come in potentially in that similar time frame or going into 27. Then scaling into full power operations from 27 to 28. When we look at the world, like the U.S. is leading in its commitment to nuclear, and then Sweden was one of the other countries that's really leading in investing in and committing to nuclear power. So partnering up between the two to leverage kind of the best benefits that each country and the technologies give with the nuclear company in Sweden, which is Blykalla, was a kind of a natural fit for us.
Jacob Stedman, what are the milestones we should be watching for from Blykalla? Obviously, Oklo has been an astounding success from an investment perspective. Because we're fortunate to talk to Jake, we know the story well. What about Blykalla?
Yeah, so we're not listed yet, but you can still follow us. There are 3 things we're going to do, also with the proceeds from this round. So first is complete the design and start licensing for the reactor, so to get its first reactor park built. The second thing is the financing, and Sweden has quite an innovative financing mechanism from the government that makes it possible to access cheap debt and also lock in a certain price for a long time. So we're going to access that financing package. And then third, we're going to also work with getting the test facility in place. So Uniper, which is one of the biggest utilities in all of Europe, is an important partner to us, and they have a nuclear power plant in southern Sweden, and we're building a test facility, a non-nuclear test facility on their site. They're also an investor in Blykalla, so it's an important partner. And that's something we prioritize in the next year.
When you do list, will it be in Stockholm, or would you look at New York?
So New York is, of course, very attractive for companies all over the world, right?
Yeah, not London, though.
I mean, I would take a stand for now, but I think New York is clearly where most people look these days.
I don't want to put you on the spot. We just did a story about London IPOs.
Okay,
They've fallen out of the top 20. It's been a tough market.
It's been a tough market. Yeah. No, I know. It's
guys, great having you on the desk. Thanks so much for joining us. I hope we can continue these conversations. Jake DeWitte there of Oklo and Jacob Stedman of Blykalla. Now, CoreWeave inks a deal with Meta that underscores the massive costs and developments for running advanced AI models. We're going to talk more on that next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. 20 minutes into the trading day, we're looking at red arrows. 66.49 on the S&P 500, down about 0.2% as we're really weighed down by a lot of big tech stocks, but not Nvidia, so it could be worse. Nasdaq down about 1/3%. You can see gold coming off a record high, but still at 38.28. It is up there. Take a look at some of the stocks that are moving. Exxon Mobil, one story today, they're going to fire another 2,000 employees. They've been restructuring for 6 years now, and this is part of that bigger global restructuring. There'll be global jobs lost. You can see Hertz gaining just about as much, about 0.1% right now. A lot of interest in the Ackman investment in Hertz. Spotify coming down 4% after it replaces its CEO and chairman of the company. And then EchoStar rising as there's more talk of spectrum sales, this time to Verizon. Meta Platforms coming down. It's going to pay more than $14 billion for, compute power to rent compute from CoreWeave. CoreWeave is up 12%. So a massive deal for CoreWeave. And I'm going to go over and talk to Ed Ludlow from Bloomberg Tech about that right now. He joins us here at the desk. Ed, great to have you in New York. This is, to me, such a fascinating story because you were talking to the CEO of CoreWeave the other day on Romain Bostic's show, The Close, and they've done exceptionally well, even though they don't make
They've done well to land contracts.
Yes. They don't make the servers, right? They just set these things up and rent the capacity out to hyperscalers, normally just to Microsoft, but now to Meta.
This is the definition of Neo Cloud. You own and operate the facility, but you're just renting the capacity. And they are shuffling the pack a bit because this is a deal that stretches through 2032. But when is it actually going to come online? Because just a week ago, the CEO told us we're kind of supply constrained. Yes, right now, Microsoft is 71% of our business. And for every unit of compute that comes online, they're having to make a hard choice. Like, who do we give it to? Microsoft or OpenAI, and now Meta. But my sense is that maybe in the next couple of years that Meta will start using this stuff.
It does look like the market believes it. I mean, up 12% today. And this is kind of like, when Rivian takes orders for a car that they don't make yet, right?
Correct.
You don't know how real
it's pipeline, But remember, post-IPO, the biggest sort of skepticism in the market of CoreWeave was concentration risk of a single customer, Microsoft being 71%. And, that is something that Intrata has commented on. And this move in the stock, it's a signal that they're getting credit for moving away from Microsoft. Meta is going to be a big spender on infrastructure. And it's a signal that, as that happens broadly in a field of many players, CoreWeave can take on new customers.
Well, I look forward to your coverage of it at 11. Ed Ludlow, co-anchors Bloomberg Tech. Also today, after his program at 12:30 p.m., Ed is going to discuss AI in-home products like Alexa with Amazon's Senior Vice President of Products and Services, Panos Panay. That's an interview you don't want to miss. Very interesting stuff going on in tech today with the Google payout to President Trump and more coding power, longer coding, staying power from Anthropic. So a lot to talk about on Bloomberg Tech. President Trump also is going to announce a Pfizer drug pricing deal today. This, according to the Washington Post. He's going to make that Pfizer announcement, I guess, around noon-ish, depending on how quickly he gets out of Quantico. We'll bring it to you live, but Pfizer is going to sell drugs through Medicaid at lower prices, according to the Washington Post, and we'll be waiting for that announcement. Coming up in the next hour, Goldman Sachs' David Kostin expects IPO and deal activity only to get stronger in the new year. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment, but I swear she's coming back. Don't worry, she'll be back. Let's kick it off with some economic data that we're looking to break. JOLTS is about to come out, the job openings data that's so important to this economy, and especially this week is going to be key to judging the economic performance, considering the fact that we probably won't get the jobs number on Friday. And it does look like we're getting more job openings than had been anticipated in our survey, and also more than we saw in the previous JOLTS release. 7.227 million job openings, and the previous release was revised up to more than 7.2 million job openings as well. So the quits level isn't as high as had been anticipated, and isn't as high as it had been last month. But I think the more important number is the openings level. The layoff level is also lower than had been anticipated and lower than we saw last month. And then we're getting consumer confidence from the Confidence Board as well. It's weaker. 94.2 is the headline reading for Conference Board consumer confidence. Comes down from 97.4. I mean, it's also lower than the 96 that we were anticipating. So confidence doesn't look as good, but there are more job openings than had been anticipated. Stuart Paul of Bloomberg Economics joins us to wrap all of this data up at a moment's notice. What do you think?
Well, the thing that's most important to me right now is that we already had the payrolls number from August. And even though we did see an uptick, just a 19,000 unit uptick in the number of vacancies in August, that's not translating necessarily into hiring. When we look at the totality of labor market data, and we compare, again, JOLT to payrolls, sure, job openings are most plentiful in professional and business services, but that's an industry that's been shedding workers for 4 consecutive months. When we look at the ratio of job openings to available workers is right about 1-to-1, right? Roll back the calendar a year, and there were about 10% more job openings than there were workers. So there is a cooling of labor demand, even relative to labor supply, when the labor force is already being affected by immigration policy. You have slowing growth in labor supply. Quits rate, as you mentioned, critically important. Slowing churn in the labor market. Workers recognize that they have fewer prospects for new employment at higher wages. That slowing churn in the labor market means that wage pressures are going to be abating. That means that labor-induced inflation pressures are going to be waning.
Yeah, it doesn't even really change that much. I'm looking at the ECAN function, ECAN Go. If you have a Bloomberg in front of you, you can type JOLTS in there and get a better look. I bring it down to 6 months to see how it's changed recently, and it hasn't much. So the job openings remain the same. I guess it's got to be good news that the layoffs are lower than we previously expected, or although at some point they're likely to come, right? What do you think about this?
Well, so we're just starting to see, we're seeing some additional layoffs as are being reported by Chevron, for example, but as you say, the layoff rate is very low right now. What I think, again, is important to emphasize is that vacancies are not translating into hiring. And there is a very tenuous balancing act in the labor market right now with very slow growth in labor demand, basically flat, and very slow growth in labor supply. We just saw an uptick in the labor force last month. We had seen at least 2 months of declining labor force participation and decline in the total number of workers in the labor force. If we continue to see folks staying in the labor force and dwindling among the ranks of the unemployed, you could expect to see that unemployment rate continue marching higher, even if we do have an increase in the number of job openings. As we look forward to September, remember, these job openings data are stale in August. As we look forward to September, the alternative data sets that we use, whether it's LinkUp, whether it's Indeed's hiring lab, whether it's surveys from the NFIB, for example, looking at hiring plans, it looks like postings are becoming a little bit fewer and more far between in September. So I wouldn't be surprised to see a tick down next month. Again, this was just a very minor uptick for August. Would not be surprised to see a tick down in September.
All right, Stuart, Paul, there from Bloomberg Economics. We'll continue to watch the terminal for your research, and we'll get you back on next time we have some big data. Well, let's talk right now with David Kostin. He is the chief U.S. equity strategist at Goldman Sachs, And David, I want to get first your take on the potential of a government shutdown. This JOLTS data made all the more important by the fact that we may not get the jobless, the NFP number on Friday. How much does that matter to you?
Well, the expectation is there may be a short-term shutdown. I think the more fundamental story behind the equity market is eventually the data will come out, and the idea of what's a fundamental thrust to economic activity is the economy is still growing. The likelihood of a recession is low. If we look at the underlying earnings expectations, around 7% earnings growth for this year and 7% for next year. Matt, what people are really going to start focusing on is what are the third quarter results, because that's not going to experience a shutdown. Corporations will report their results. Expectation right now is very low bar, around 6% year-over-year earnings growth. The median stock, in fact, around 8%. So that's still pretty low because last quarter, the average for the last several years has been around 400 basis points faster earnings growth than expected. If that pattern was to continue, Matt, you'd be around 11% earnings growth for the overall market. So that's the more important variable from a corporate fundamental perspective. Obviously, the valuation of the stock market is pretty high, around 23 times earnings. So that's a concern, probably constraint on the magnitude of appreciation. We look at the trajectory of the overall earnings growth for the next year, around 7%. It's pretty much matching our view on the S&P 500 index level, climbing to around 7,200. 7,200 a target in about 12 months' time. I think that is the more fundamental discussion points with portfolio managers right now.
David, you mentioned the median company is expected to grow earnings by 8%. And, I wonder when I look at double-digit growth expectations, which is what it would be if they beat by 400 basis points, right? Is that the Mag 7 or the Great 8 or the top 10 AI stocks that are driving that growth, or is the S&P 493 catching up?
No, I think it's an important point that the expectation for growth in terms of earnings growth for the largest companies in the market, call the sobriquet what you like, but the idea of well into the double-digit forecast is what the baseline expectation is, something in the mid-teens, and that's likely to be a reason, certainly has been a reason why those stocks have done so well. The expectation that they'll continue to grow more rapidly. These companies expect to grow more rapidly in their sales than the rest of the market is why these companies traded a meaningful premium. They trade about 10-point greater PE multiple than the rest of the market. So you're paying a higher multiple, but you're also getting what's expectations of much better growth, higher margins, and sort of the fundamental story behind AI. I think the issue that investors will be focusing on is if the broader universe of companies can identify some concrete examples of how they are using AI and the various forms of technology to enhance their revenues or alternatively improve their margins or lower their costs. Right now, it's been pretty underwhelming in terms of the case studies or examples that we find. We find most companies are really been focusing on the cost-saving side of it, not so much on the increased revenues as a result of adopting AI or embracing AI. So I think some evidence around that and the idea of the ability of AI to be enhancing the growth of companies would be something that we're certainly going to focus on for the third quarter results when they come out over the next month or so.
If you take a longer view, David, are you worried at all about a bubble? You've had a long and storied career, right? You've been at Goldman Sachs since before the dot-com bubble was inflated and burst. So do you see parallels here? Because when we start to get these announcements of one AI company investing double-digit or even triple-digit hundreds of billions of dollars into another AI company, it's a little worrisome for the market.
I think the point you made, Matt, is an important one. Yes, there are some parallels. I think the parallels relate to vendor financing. The idea of vendor financing was a real story behind some, not all companies, but some of the companies in the late 1990s accelerated their revenue growth. And when the actual customers could not necessarily come through on those payments, that was a notable discount. But another way to be thinking about it is in the words of the book that George Soros wrote on the alchemy of finance and the way that companies, the idea most finance people think about the price of a company, price of a stock, represents the discounted future expectations of the business. And what Soros's observation was that, in fact, the price action of the shares itself was integral in thinking about the valuation and the momentum of the companies. He reduced the idea of the alchemy of finance to the theory of reflexivity, and the idea that as a company acquired something else, the multiple would go up, the growth rate would rise, the multiple would go higher, et cetera, et cetera. And that reflexive nature would spiral up for a period of time, and at some point then that would start to spiral down. And I think that idea of vendor financing, alchemy of finance, those are some sources of concern that that we think about. But broadly speaking, the economy continues to grow. The idea of earnings are still rising, and the idea that that share prices are likely to go higher, I think, is a more fundamental issue. Some of the areas probably is in the private market area. We don't get great clarity or line of sight into what's happening from in that area. I think in the public market, some of the largest companies, their margins are super high. They're growing obviously quite rapidly. They got a lot of cash flow. They're basically able to fund a lot of the capex. I think the source of concern, from my perspective, would be some of the areas within the private markets. If you think about positioning, which is the other kind of angle, which is right now the positioning data we look at across hedge funds, mutual funds, foreign investors, that would suggest that investors are sort of neutrally positioned, maybe slightly under risked, if you will. And so that would be a source of additional demand for shares. And so I think those are the areas. And of course, the big area of focus now is on the IPOs and the M&A activity. The IPO market has been very robust this year. And the M&A activity obviously up quite a lot. We're expecting another 15% rise in M&A activity as we look into next year.
Yeah, I mean, we saw great news from Jefferies out this morning. You mentioned that we've seen $24 billion worth of IPOs. I think 46 that are over 25 million. So it's been a fantastic year thus far. Does that momentum continue? Do you think M&A is back, IPOs are back for this market?
I think the way you want to think about it is a couple ways. Number one, we have an IPO barometer, which measures how conducive is the market to receiving IPOs. We're now rating, or the barometer is reading around 140. Put some context around that. 100 is sort of the average conduciveness, receptivity of the market for IPOs. 100. We're 140. The peak in 2021, February 2021, was just over 200, and the low, the nadir, was around 7 in November of 2022. So you give some sense, we are well into the positive territory, around the 88th percentile versus history. It's point one. Point two, if you look at the performance of those IPOs you referenced, 70% of them actually have had positive results since they went public, number one. Number two, the average performance is up on the first day, up 30%. The typical performance, Matt, over time is around 15%. So it's kind of twice as positive results as is typically the case. That's sort of the IPO market. And then you look over into the M&A market. Obviously, lots of activity here. It's been up like 30% or so year-over-year basis. And one of the this investment program, and think about how does one invest? How does a portfolio manager think about investing? What has not participated in the rally? We would point to some of the alternative asset managers, which have underperformed or lagged our measures of macro forecasting, what we would think would be those shares' performance. They've lagged. We think that's an interesting opportunity. My colleagues who cover the stocks would look at Carlyle, would look at KKR, look at TPG as examples of companies where there is growth, reasonable valuation in this M&A activity. If the M&A activity environment continues in the IPO market, those are some of the beneficiaries that we would think about.
David, great to get some time with you. Thanks so much for joining us. David Kostin there, the Chief U.S. Equity Strategist at Goldman Sachs. Let's get a look at some of the markets that we're following for. You can see the S&P 500 down about 0.2% as you've got most of the big tech companies on the loss side of the ledger, although NVIDIA still holding us up to some extent. NASDAQ down about 0.3%, and the 10-year yield coming back down now to 4.10. Let's get a look at some of the single stocks moving this hour. Pfizer shares are rising. The Washington Post reports that President Trump will announce an agreement with Pfizer to voluntarily sell its medications through Medicaid at lower prices. And as a result, the almost 3% gain there. CoreWeave has signed a deal to supply Meta with as much as $14 billion worth of computing power. The move helps diversify CoreWeave's business away from Microsoft, which has been its largest customer to date. And Exxon plans to cut about 2,000 jobs globally as the oil giant continues its restructuring, consolidating smaller offices now into bigger regional hubs. It's part of a long-term plan that saved more than $13 billion in costs since 2019. Coming up, deal making is back. You heard it just now from David Kostin, and Jefferies told us as well. Record revenue for the third quarter signals a positive outlook for bank earnings season when they kick off in a couple of weeks. We'll discuss that next. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Millennium Management has taken a hit from the collapse of auto parts maker First Brands Group, booking losses of about $100 million. First Brands owns Fram Filters and Anco Wipers, filed for Chapter 11 in Texas with as much as $50 billion in liabilities. Some rivals, including Apollo, scored gains by betting against the troubled car parts maker. U.S. family offices are paying record salaries to lure top money managers. A new survey shows nearly 1 in 5 CIOs earn $1 million or more a year, more than anywhere else on the planet, with over $4 trillion now managed for the world's richest families. These firms are growing more professional and more expensive to operate. And running isn't just cardio in New York City, it's cash flow. The city's races generated nearly $1 billion for the economy in the past year, up from 58% from 5 years ago. Last year's marathon alone brought in almost $700 million, with visitors spending big on hotels, dining, and transit. This year's race is set for November 2nd. Finally, Jefferies reported record quarterly revenue, for the third quarter, as deal activity picked up worldwide. The CEO sounded confident in the firm's outlook, saying the IPO and deal market will improve despite economic uncertainties. Let's discuss this with Allison Williams, Director of Research for Bloomberg Intelligence. And Allison, Jefferies, because it has its fiscal year ends in November, comes earlier than the other big Wall Street banks that report October 14th and 15th. What do we know about what they'll report from what Jefferies brought us this morning?
So I think the positive sign from Jefferies is really on the deal-making front. Equity fees, very strong. And for Jefferies, M&A, a record quarter. And so that's really where we expect to see some strength for the big global banks. We have also had some guidance already on trading and fees. JP Morgan, which is the biggest globally, expecting something like 15 to 20% growth in trading from a year ago. So that is very strong, especially considering where we've come from. And fees as well, up within the 10 to 15% range. We think that there could actually be upside to those numbers. And results will vary across the firms, but what we are seeing is strength in equity markets. That's not surprising, given that we had both the world's market cap and the index hitting a record high in September. Prime brokerage has been a business that's on fire. We had record balances in second quarter. We expect we could see more records this quarter. But we've also seen strength in fixed income trading, on rates, as well as spread product, so credit trading and structured product as well.
I wonder about trading, and just because Jefferies shouted out volatility that helped drive their book, I guess reflexively look at the VIX index, Allison, and I'm thinking, why? There was a huge spike in April, but otherwise it's been low. How important is that to you as a bank analyst? Are there other volatility signs that you're watching?
So we generally do look at volatility, because when there's a lot of volatility, that signals a lot of activity. However, what we've been seeing is a lot of activity, regardless of the fact that volatility is low, because investors, I think, are positioning with, as I said, asset price is so strong. We have stocks at record high. We have credit spreads across asset classes very tight. So we are seeing a lot of derivatives and hedging across different asset classes, just given those levels, even though we are seeing the volatility low. And then, as I said, within prime brokerage, just the balances and the leverage that pushing the sort of the asset classes to record highs, also very good for the trading business.
In terms of the Jefferies report, another thing I was thinking about was the league tables, right? If they're doing well, is everybody else going to do well, or are they taking, eating someone else's lunch? How are the league tables going to shake out at the end of October?
So I think, for Jefferies, and keep in mind that there are certain areas that they're stronger in. I mean, M&A is definitely a business where they punch above their weight. We're seeing a lot of strength there. And we have seen a lot of sort of the boutique models, if you will, moving up the league tables over the very long term. Now, the mega deals that really have dominated this quarter do suggest strength from companies such as Goldman, which has led in M&A revenue for several decades.
All right, Allison, thanks very much. Allison Williams there runs research for Bloomberg Intelligence. Tomorrow, Bloomberg Television will have live coverage of the Women, Money, and Power event in London, convening the most influential female voices in finance from around the world. That's why Allison is there. That's why my co-host Dani Berger will be there, and she's going to bring us interviews tomorrow throughout the day right here on Bloomberg Television. This is Open Interest. Let's get a quick check on the markets right now. We're off about 0.1% on the S&P 500. NASDAQ down about 0.3. Really not much change at all since the opening bell an hour ago. The 10-year yield is coming off. It had been 4.10. Now it's at 4.12. One stock to watch today is Pfizer. Washington Post reporting that President Trump will announce a drug pricing deal with the company. And the Wall Street Journal says the CEO at Pfizer is expected to announce a $70 billion U.S. investment. We come back, we'll switch to watchmaking and talk to Shinola. Detroit-based watchmaker Shinola extending an offer to watchmakers around the world. The company is, taken out a full-page ad earlier this month in the New York Times, inviting peers to consider moving their manufacturing to Detroit from Switzerland. For more on the offer, we're joined by Steve Katzman, Shinola CEO. And, I'm a big fan of Shinola products. I've been in your store in Detroit. I own different versions of sunglasses and watches from you. But Swiss watchmakers are never going to move away from Switzerland. I mean, that's kind of the whole point of their business model, right?
Yeah. Hey, Matt, thanks for having me today. Look, we think it's a new day in the global watch community here. And we're inviting the Swiss to participate with Shinola to make watches here in Detroit. And really, we believe that with Swiss precision and Detroit ingenuity and grit all under one roof, that it's a win-win for both our countries. And that with this combination, we believe we can grow the overall American watch market, and for that matter, the overall global watch market.
All right, so, you put the ad out earlier this month. Have you gotten any response from these Swiss artisans who make the most famous automatic watch calibers in the world?
Yeah, so we have gotten outreach from a good handful of them, especially, I don't know if you caught the news, but in the month of August, the Swiss watch manufacturers reported that their exports to the United States is down over 25% year over year. And today, the Swiss exports close to $5 billion worth of watches to the United States, which is its largest market. And so there's a lot of interest because partnering with Shinola will help not only expand the marketplace in the U.S. and potentially the global at large, but it will help bring down their overall costs, which is clearly having an impact on their sales.
How have your sales fared as Americans buy fewer than Swiss watches? Are they buying more Detroit-made watches?
Yeah, so our watch sales through August are up year over year. And it's clear that Americans want to buy more goods that are made right here in the United States. And we believe that there's a global demand for products that are made in America. So in some regards, it's definitely helped us.
You make other products besides watches. I've seen bicycles in your store, as I said, sunglasses, phonographs. Where does Shinola want to go as a brand? Will you focus on watches and just collaborate with other manufacturers, or are you broadening out your offering?
So Shinola was really built on wanting and a desire to bring manufacturing back to the United States, in particular watches. So for historical context, back in the 1960s, America made over 30 million watches a year and employed tens of thousands of Americans to do that. And today it's a fraction of that number. So we're looking to expand watches in general, but we're also doing a lot of interesting things with leather, jewelry, and as you mentioned, we do turntables and other what we call lifestyle type products that fit within our product categories.
So how many more jobs have you created then? I mean, you've been around for a while in Detroit. Obviously, we've watched, to some extent, a decline of U.S. auto manufacturing jobs. Are you taking up that slack?
So we are. So we've been retraining Americans to become world-class watchmakers. That was part of the original ethos when Shinola was founded. Today, our platform, Bedrock Manufacturing Company, overall employs over 600 team members, and that's growing every year.
I'll ask you just quickly about, since you mentioned Bedrock, Filson, another one of my favorite brands, makes a lot of its products, and you own that brand as well in the U.S. Are you seeing overall a resurgence in American manufacturing? Because these products are coveted by, consumers.
Yeah, absolutely. Filson is just an incredible brand. It's a 128-year-old heritage brand, and the quality is phenomenal. And there's a rich heritage of multi-generations that have been purchasing the product. And there's a real desire, we see it every day, of consumers interacting with our team members on our website, looking for product that's made in America by Americans. And we have a factory in Seattle where Filson was founded that we're making our icon products, and we continue to expand what we're making in our factory in Seattle.
Are you able to avoid the tariff hit from the input goods from stainless steel to aluminum, titanium to, cotton and wool, or do you take a hit from those just like other manufacturers?
So we're clearly being affected by tariffs like all other manufacturers. But what's unique, especially on the Shinola side with watches, because we're importing componentry parts, the cost on componentry parts is small relative to when you think of Switzerland, where they're exporting a finished watch and paying a full tariff on a finished watch. The largest cost of a watch is the labor itself. So what we're offering and able to offer the Swiss manufacturers is import the componentry parts here to America, let our team members build the watches, and it will help mitigate the tariff expense in a very significant way for them.
All right, Steve, fascinating stuff. Hope to get you on the program again. Steve Katzman there of Shinola with their platform, Bedrock Manufacturing. They also run Filson brands. Let's get a check on the markets right now. We're just over an hour into the trade, and we've seen losses that are little changed from the top of the hour. You've got the S&P 500 still down just about 1 to 0.2%. The NASDAQ down about 0.2%. It had been off almost a third. So getting a little bit better, but not a lot of movement. And the same can be said for yields. We were down to 410, but we're still down around 411, 412 if you want to round up. Still a lot better than the 420 and change that we were seeing in the last couple of sessions. In terms of the single stocks moving at this hour, there are a lot of single stock movers to talk about. Spotify is one of them. The founder is stepping down as CEO after almost 2 decades at the music streaming company, effective on January 1st. Spotify's current co-presidents will take the reins as co-CEOs on that day. Shares of Firefly are falling after the company disclosed an incident during a test in Texas. that resulted in the loss of a rocket stage. The incident comes a week after the company delivered a disappointing first quarter earnings report. And you can see they're losing more than a fifth of their value today. And keeping an eye on Amazon as the company rolls out a slew of new home security appliances from its Ring and Blink brands, serving up an end-to-end push into 4K video. Amazon also announcing new 4K Fire TV streaming sticks. And today at 12:30 p.m., as we've been telling you, Ed Ludlow will sit down and talk about these products with Amazon's Senior Vice President of Devices and Services. Coming up, the AI spending boom is starting to cause some concerns. We've been talking about it on this program for days now. We'll speak with David Crawford of Bain & Company on his study. This is Bloomberg Open Interest. AI CapEx has been the dominant theme in equities since ChatGPT turned everyone's attention to the technology. But the proliferation of data centers across the U.S. is putting major pressure on supply, energy supply, and sending wholesale electricity costs soaring for customers who already struggle, in some cases, to pay their bills. For more, let's bring in Bloomberg reporter Josh Saul. You wrote The Big Take. You were part of a team that wrote The Big Take last night, and it is incredible. I immediately sent it around to everybody I know because you've got stories in here of people who are already struggling to pay bills on a fixed income, living far away from, these AI hubs and still seeing prices rise 100, 200, almost 300%. How is this happening?
Yeah, well, AI can drive up power prices in two main ways. It can drive up your power bills in two main ways. The first way, simple supply and demand. AI data centers suck up a huge amount of electricity, and that, just to really summarize, can make electricity more expensive for everyone else. And the second way is that it requires a lot of infrastructure. You need to build big transmission lines across the land. You got to build big, sometimes big new generation to power all those data centers. And those costs, the way that utilities traditionally work, those costs are spread out among all customers. So those are two ways. You won't see a line item on your power bill that says AI data centers, but those are two ways that those are going to show up on your bill.
So what can be done about this? I would have thought, regulators are all over this industry. And so you had a man in Baltimore, he's blind, living on social assistance, and all of a sudden he's paying or being forced to pay double or triple what he had previously been. Why is that not regulated to some extent?
Yeah, it's the way that our system works. Any new load that's brought onto the system, the cost is spread out among everyone. That makes a lot of sense if it's a new house or a new subdivision. But the new load from these data centers is so big that it's kind of overwhelming the traditional ways we've done that. We've seen that in the PJM market. The Pennsylvania Governor Josh Shapiro recently held a summit in Philadelphia to say the way the market is working, the way that we've paid for reliable power in the past is not working. And he threatened to leave that power grid if a way to figure out these demand increases isn't figured out.
You have a great chart in your story that shows where prices are rising the most across the map, right? And of course, the coasts are getting hit a lot harder than the middle of the country. But even, here we see Ohio up 9%, Iowa up 8%. Even the Midwest is taking a hit. Where is it the worst?
So that chart's showing the percentage of electricity that's used by data centers in any given area. And that's going to be the highest in the data center hotspots like Virginia or Ohio. In terms of where prices are going up the most, you're seeing that in a lot of the same places. And this is not going to stop because data centers are going to consume more and more electricity. Bloomberg NEF's estimate is that by 2035, data centers will be using so much energy globally that if they were a country, they'd be fourth behind only China, the US, and India.
So what kind of response have you gotten to this story? Because I imagine it's pretty jarring to some people, especially in government who have an interest in keeping costs capped, right? One of the reasons President Trump was elected is because of the inflation that we saw under the Biden administration.
It's really tough. It's really tough for regulators and politicians because obviously keeping prices low is a really important thing. But as my managing editor has come to say, electricity is the new eggs. The inflation of electricity is sort of starting to become a political flashpoint the same way eggs were over the past couple of years. And you could almost say eggs, ushered Biden out of office. So politicians have a lot to worry about with power prices.
What's next? We were talking with Jacob DeWitte earlier, the CEO of Oklo. They're betting on nuclear power and smaller modular reactors. However, it's not going to come online for years. So how much longer are we looking at these elevated prices?
Definitely for years to come.
And I guess they'll continue to rise as we get more and more people using AI.
That's what Pennsylvania Governor Shapiro was trying to address when he held this summit. That's what people in Baltimore, rich people and poor people, are worried about as they see these prices keep going up.
So there's no light at the end of the tunnel, dude?
Utilities are definitely addressing it. Utilities are doing a lot of things. They are requiring data center developers, the big tech firms that we all read about, to pay for larger shares of the transmission costs and the other costs that they are creating by bringing these data centers on. So there's definitely utilities are doing things, but some things like the upward impact on wholesale power prices that are then passed on to customers, those aren't addressed by those reforms. So definitely utilities, regulators, and politicians are all making reforms and tweaks around this, but there is still some upward pressure that is going to keep pushing up customer bills.
All right, Josh, thanks so much for joining us. Bloomberg power reporter Josh Soul. Highly recommend you check out our big take to see, everywhere pretty much prices are rising for energy. It's worse in some places than others, but the stories in there are pretty touching. They get pretty personal, so really great reporting. Let's get a check on what's going on in terms of the markets right now. We still see a drop of 0.1% on the S&P 500. The NASDAQ is pairing some of the losses that we'd seen earlier, about 0.3%. The 10-year yield continues to move down right now, off by about 3 basis points to 4.10, 4.11. That should give a little bit more room to stocks. We're coming to the end of a month which has been pretty strong, actually, considering that September is normally one of the worst months for these equity indexes, at least over the past 30 years. We've had a gain of almost 3% for this September, and we're just about to get into the fourth quarter. Coming up, the U.S. government moving closer to a shutdown. That's at 1 minute past midnight tonight if there's no deal, and we don't see one in sight here. We'll get the latest from Washington, D.C. next. This is Bloomberg Open Interest.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
That was Vice President J.D. Vance speaking yesterday at the White House. The U.S. is getting closer and closer to a government shutdown. It'll be 1 minute past midnight tonight if Democrats and Republicans don't agree a plan to further fund the government. Joining us with more is Bloomberg's senior editor, Wendy Benjaminson. And Wendy, it's so fascinating to hear the tables turned like this. Normally, it's Democrats accusing Republicans of taking the United States government hostage and putting a gun to its head. And now the shoe is on the other foot. How can Chuck Schumer and Hakeem Jefferies do this?
Well, I think we are indeed hurtling to a shutdown, Matt. There's neither side is talking today. Yesterday were the only talks there were, and those talks resulted in no movement because the president has this negotiating strategy, which is here's my deal, take it or leave it. And the Democrats said, well, but we have some things we'd like to discuss. Could we do this or that? And they said, take this deal now, and later we will talk about, these health care cuts that they want restored, that the Democrats want restored. And the Democrats are not in a position, really. They say they can't really trust the Trump administration to come back after 12:01 p.m. tonight and actually negotiate this. They don't trust that that's going to happen, so they want it to happen now. And that's where we are. There will be a vote this afternoon, but there are no plans for negotiations ahead of that. And then there'll be another vote later tonight.
So how long do you think this is going to last? What are people in Washington saying? Will this be a long shutdown, the likes of which we saw in 2018, 2019 during President Trump's first term, or is it going to be a couple days until they agree on something and get services back up and running?
Well, I would right now predict another version of 2018 or 2019. On the other hand, what they could do is then say, okay, let's pass a 1 week continuing resolution that'll fund the government for 1 week. And then in that week, let's talk about these health care cuts. I think the Democrats will be spending a lot of energy messaging on these health care cuts, which is the Obamacare subsidies are going to end, and there will be other cuts that they want. And I think they'll be messaging a lot that the Republicans are doing this to you, the American people. The Republicans, of course, are already calling it the Schumer shutdown. And so, you know, if they don't do a short-term bill after this, so there is time to negotiate, at the moment, I don't see a way out of this.
Does this look almost like
caves?
Does this look almost like a gift, Wendy, to President Trump? Because he's been wanting to reduce the federal government headcount. He tried it with DOGE. He faced a lot of pushback in the courts. And now, rather than furlough workers, he can simply fire them. Is that what the Democrats are letting the Republicans do here?
Yes, in a sense. I mean, he did actually accomplish quite a number of firings with DOGE. You're right, not as many as they restored a lot of them when the court stepped in. And this is something that was already in the works, was a fall firing of more federal workers. And I do think, you know, yes, that Trump was hoping that at least the senators in Virginia and Maryland, who are Democrats, who have a lot of federal workers in their states, would force them to the table. But Schumer and Jefferies and those leaders are all saying, look, he was going to do this anyway. Don't fall for it, and let's hold the course for the health care subsidies.
All right, Bloomberg's Wendy Benjaminson in Washington giving us the lowdown. We've got, I think, 13 hours to go until we are likely to see the government shut down. Let's get a check on the stock market right now. This is the move screen. You can see we're down just about 0.1% on the S&P 500, and the breadth is pretty evenly split. Two stocks up for every three that are down right now. But the more interesting thing is to look at the breakdown of the winners and losers. NVIDIA is holding us to some extent back from further losses, adding 14 points to the index. But you see some big movers on the downside. Amazon is off. Meta is down. Alphabet is off. And you now see JP Morgan swing to the loss side of the ledger as well. But for the most part, you've got these big tech stocks down and weighing on the index, which is why we see a loss right now. If you take a look back, though, a longer-term look at the month of September, it's been pretty good. It's normally one of the worst months in terms of seasonality for stocks, averaging over the last 30 years. This September, we've seen actually a gain of 3%. So October and November seasonally are pretty good as well. Coming up tomorrow, Citi's Stuart Kaiser, Andrea Andreeva of Piper Sandler, Ann Berry of Threadneedle Ventures, and the CEO of SailPoint joins us, Mark McLean. Plus, my co-host Dani Berger is in London, where she'll be reporting from Bloomberg's Women, Money, and Power event. This is Bloomberg.